Hi, this is Antoine Harris with Platinum Bridge Wealth Strategies, and it's been a volatile ride the last several days. So, Friday was my birthday. I spent most of my birthday talking about Donald Trump and tariffs, which is not what I intended for my birthday. As I look at what's happening today, was Monday the 7th, I've started recording this video several times, and it's been such a chaotic event. I've had to stop and restart several times because the market today has had a variation of 8%, down significantly at one point. It made a full recovery based upon a rumor that President Trump was going to pause these tariffs for 90 days. And then that was quickly retracted by the White House. And then the market went back down, then recovered again. So we just need to take a step back from all this volatility and think about the overall discipline and planning that we exhibit within all of these plans. We do this for a reason. So if you are retired, we systematically have at least 2 years of your withdrawals in cash or cash equivalents, just for periods like this. We back that up with several years of bonds or bond equivalents to support that 2 year withdrawal bucket for people that are retired. If you are working, I think this is a great opportunity for you to continue to add to your retirement accounts, to your 401k accounts, because the events that we're seeing right now, one, it's not a systemic event like what we've seen historically that's based on the overall economy or a problem with the economy. So back in tech wreck that we saw back in 2000, that was a systemic event where you had these internet companies that had been so inflated and they started to go out of business, and then the market tanked and it brought the entire global market down with it. In 2007, 2008, you had all these bad loans that had infiltrated the system and a lack of banking discipline and banking assets to support the overall financial infrastructure around the world. And that precipitated a significant decline that lasted for several years. In this particular situation, the economy was doing fine. So the issue that the market has is that these tariffs have been implemented by one person based upon his philosophy, supported by advisors around him that support that philosophy, and it could change at any moment. So just like we saw today with the volatility today, this is not really a tradable event because it's such a dynamic situation and the market will respond so quickly. There's not going to be a signal that, hey, this is going to be the end of the tariffs or the tariffs are going to adjust. It's probably going to be a tweet, some kind of announcement, some kind of headline that's going to drive the market one way or the other. So take a step back. If you're adding cash to this market because you're not retired, I think longer term that's going to play out. The market has been down 20% as of today. So April 7th, we hit the quote unquote bear market threshold. That's down 20% from the top. Now, again, because this is a unique situation that was not based upon an economic issue, but based upon tariffs that were imposed upon the market, that could change dynamically at any time. This is a different type of situation. Also, we're starting to see some pressure internally and externally on the Trump administration based upon how these tariffs were implemented, even from people that actually supported the president and these policies. So for example, Elon Musk apparently is not on board with all of these tariffs because it's impacting his company Tesla, and he feels these tariffs are not being implemented the right way. You have other billionaires that have come out and started to speak out against the implementation of these tariffs. We've recently seen some legislation that's been introduced, a bill for Congress to take back their control over the implementation of tariffs and not allowing this very obviously significant power to be in the hands of one person. So that bill was introduced on Friday, April 4th, and we're still in the process of this recording for trying to get more support around that. The point is, as we start to look forward and think about the midterm elections in 2026, it's probably not going to be politically expedient to have, against the backdrop of those midterm elections, an overall recession for the US economy that was initiated at the behest of Donald Trump and these tariff policies. So I would expect over the next several months, we're going to start to see these tariffs adjusted downward. Now, that's my view right now. Of course, these markets are very volatile. They can continue to go down. But as we take a step back and look at what we've done from a planning perspective, where we anticipate us being in the future, allow me to show you a couple of charts that can hopefully frame your longer term perspective here. The first chart I'd like to share are intra-year declines versus calendar year returns. And the very basic way to view this is the orange at the bottom shows the lowest point the market reached in a given year, and the top in blue shows where the market ended. So, for example, in 2003, the market was down at 14% at one point, but it ended the year up 26%. 2009, the market was down at 1.28%, but it ended the year up 23%. And you can see so on and so forth. When we have volatility intra-year, it doesn't mean we're going to end up at that same level of volatility by the end of the year. Now, I have no idea how long this volatility will persist. Of course, we could certainly go down more. Just because we're experiencing a tough period so far this year, especially given this situation where it's such a dynamic situation that's so headline dependent, things could change very quickly depending upon how all of this plays out. So even 2020, we were down 34% at one point, but ended the year up 16%. The story's not fully written this year, so I just want to make sure that we're not panicking during this period of market volatility. The other chart that I like to share really just shows the US stock market, the S&P 500 since 1970, and all the different things that we've had to deal with. We've dealt with wars, we've dealt with the tech wreck in 2000, we've dealt with the financial crisis, we had Russia default on their debt back in 1998. We've dealt with COVID. As you see, despite all these things, and there's many that I'm not even mentioning right now, the market continues to go up and to the right. So as long as we're able to take a step back, take a broader perspective here, when we have markets like this, a bear market, on average, they've lasted roughly about 11 months. That's what we've seen historically. Whereas the bull markets last on average, about 4.3 years. So we may be in for a tough ride here for the next several months. We do not know how long this is going to play out. I have confidence that we'll get our bearings and get ourselves back on track longer term. So just with that perspective, this could be a difficult few months that we're dealing with. We do not know how long we're going to be in this period of volatility. Just take a step back. Do not panic. If you have money to invest, this may well present as a long-term buying opportunity for you. So this may be actually a good period to get some money back into the market. I would not put all of the money in immediately. I would do so gradually over time. If you do have money to invest, if you're adding because you're still working through your 401k account or your 403b, that happens typically when you get your paycheck. That's going to be a gradual deposits into this market. I would not change your contribution level. If you're able to, you may consider increasing it. Dealing with market volatility is never easy. That's why we're here to support you. If you have any questions, please feel free to reach out. I'm happy to chat with you. This is Antoine Harris with Platinum Bridge Wealth Strategies, and I'll talk to you soon.